Bill Ackman made big headlines back in March when it was reported that the hedge fund that Bill Ackman manages turned $27 million to over $2 billion in a bet against the US market. And this month, in November, Bill Ackman revealed that he made a similar bet against the market. And today, I'm going to go over what he did back in March and talk about why he is making the same moves he did back then. So when news broke earlier this year that Bill Ackman actually made a ton of money while everyone was losing money on their investments, there were a lot of criticisms against Bill Ackman, and it made him even more well known than ever before. But how exactly did he manage to make money when businesses were closing and the future seemed uncertain? The three-word answer is he used something called a credit default swap. This is something that most retail investors probably are not familiar with, and rightly so because we don't really have access to it. But this isn't something new that Bill Ackman created. Actually, this was used back in 2008 by a hedge fund manager by the name of Michael Burry, who made his investors over $700 million in just 2 years, and he's also the man which the movie The Big Short is based on. So what exactly are credit default swaps? Basically, it's like an insurance policy for corporate loans. So as you guys know, in the world of business, a lot of companies take out loans to finance their operations or to expand their business. And much like a home insurance, the lenders to these businesses can buy insurance on the money that they lend out, so that in case the company that you lent out the money to can't pay you back, the insurance company will be able to pay you back instead. So let's do a quick example to help us visualize how this works. Let's say there's a fund that has lots of cash sitting around, and the manager of this fund decides, I want to make more money rather than just have it collect the low interest rate of 0.5%. And so they decide to reach out to a corporation. Let's say they lend this money out to Coca-Cola. And Coke will pay this fund an interest rate of 10%, which is a lot higher than what lending your money to the US government will be, because the risk is higher to lend your money to a corporation, since that company has a possibility of going bankrupt. But obviously, the US government can print as much money it needs to pay for its debts. So Coke will need to pay the fund a higher interest rate to compensate for the higher risk. And if Coke does end up going bankrupt, the fund may lose all the money it lent out. So to insure against that, they pay 0.5% to a insurance company to protect their investment. And if Coke does end up going bankrupt, the money lent out will be paid for by the insurance company. And in March, when it seemed like a lot of businesses were going out of business, the prices of these credit default swaps skyrocketed. And that's basically how Bill Ackman was able to make so much in so little time. And now I'm going to play a short clip of the interview that the Financial Times had with Bill Ackman, where he shares his thoughts on the short-term future of the economy and why he made the same bet as he did back in March.
We had not heard yet who was going to be the president of the United States, and we also had not had the announcement about the vaccine, which has clearly got markets very excited. So we're keen to know how you were positioned going into that. Obviously, markets reacted pretty well to both, and what you think it means long term.
Sure. So look, I think, this has been one of the few years in my career where I think we've had pretty good visibility on what was to come, and I think it continues. I think the next several months will probably be the most challenging for the virus in terms of, and I think yesterday's news is actually bearish for the next few months, because I think if anything, it's going to make people think of the less of a threat. I think people are going to take mask wearing less seriously, and I think it's going to. I think more people will die in the next few months, unfortunately, than in the previous period. So I think it is it's going to be a depressing, challenging time. On the other hand, I do think the progress of technology and biology and biochemistry and so on will get us out of the mess. But I think the timing is off. I think we have a vaccine that's come very, very quickly. We've got a very nice announcement from Pfizer. I assume we'll see others. But in terms of a deployable vaccine that is, creates herd immunity, I think it's next summer when we can start to feel good and safe. It's mid next year time frame. So I think that the challenge is the next sort of period just for living. In terms of markets, I share the view that I had really in March. Is that once we know that we can put the virus behind us, when you think about the value of a business, it's the present value of the cash the business generates over its lifetime, and usually that, hopefully that's 30, 40, 50 years if you're buying the right kind of business. And the strong dominant companies have done managed through this period generally pretty well, and will come out of it even stronger. And so I think that's good for markets. And so we've been positioned basically fully invested, so benefited by the market's recovery.
So we're not expecting another like hedge announcement from you.
Actually, we have put in place, credit
Oh, good.
all. Just yesterday, we put back on a very, an investment grade credit hedge, not of the scale that we had in March, but at 49 basis points, the market is saying that the world is incredibly safe, good place, and everything expected to go right will go right. And it's just I feel I'm sort of long equities and still short investment grade credit, and I feel very comfortable in that position.
So, but fair to say that the bet was made because you're anticipating that there would be global lockdowns and coronavirus was spreading.
Yes.
Is that the same premise for the current hedge that you have on? Do you anticipate, for example, England has gone back into lockdown. Do you anticipate that the US might also have to go back into lockdown at some point, given the rates that cases are increasing at?
Yeah. Look, I think what I'm saying is, I hope we lose money on this latest hedge, right? It will mean that we've managed through the next period in a very, very effective way, that, the Senate stays Republican controlled. There isn't, President Trump leaves the White House, in a limousine or helicopter, without an insurrection. Hopefully, we get more aggressive about using masks and social distancing, and we stop we're in the middle of a massive exponential growth in the spread of the virus, right now, which, can have, overwhelm the hospitals, throughout the world, let alone, in major American cities. And, we're in a pretty treacherous time generally. And what's fascinating is the same bet we put on, call it 8 months ago, is available on the same terms, as if there had never been a fire, and the probability that the world is going to be, everything's going to be fine. And I hope that's the case. And I think there's a reasonably high expectation that we're going to have a distributable vaccine, widely distributed by sometime in the first half of next year, that we're going to, the number of people dying is going to start declining at some point relatively soon. Businesses are going to recover. People are going to go back to their normal lives. So I think, this is different from the hedge we put on last March. We thought it was a near certainty that things would get really, really ugly. We put it on in February, actually. And now it's just it offers the same asymmetry. And for an investor who's 100% long equities, it's a nice insurance policy.
So Bill Ackman says that he is long US stocks. So he's not going to do a lot of selling, but he sees a lot of short-term risk because the US has done a terrible job of flattening the curve. And he believes that a vaccine will make people complacent, which will make the virus spread faster than ever. Now, I think it's interesting that he says that he hopes that he will lose money on this bet because it'll mean that the economy will be doing well in the near future, even though he obviously has a very bleak outlook on the near term. So it's hard to predict if Ackman's bet will pay off in the short term, but it is true that the number of cases are refusing to go down, and businesses might be forced to close once again. That's going to do it for this video. Don't forget to subscribe with the bell notification icon turned on, and let me know your thoughts on Bill Ackman's latest bet.